The average home value in 2008 was $180,100. In 2023, the average value of a similar home is $425,000. That means that those who bought in 2008 are enjoying an increase in value of $244,900, assuming they still have the house. That's a profit of more than 135% of the original investment. While those who did not take action in 2008 and decided to wait for house prices to drop in price are now facing an average price of $425,000, meaning if they want to buy a house now, they have to be willing to pay not only more than double, but also buy with high interest. How did that happen? Why did those people decide not to buy a house in 2008 when they had the opportunity? It's hard to know, but what I can tell you is that in the world of investments, there are many lies, myths, and misconceptions that can fill you with fear and even keep you poor. That's right. Many of us can sometimes face analysis paralysis. And in today's video, I want to go over those popular misconceptions or lies or myths that you've been hearing all along that is keeping you paralyzed. And hopefully that will help you jump to the other side of the grass and start taking action and taking control of your investment journey. So to make that happen, what we're going to do is to go over this blog courtesy of the NOVARISE team. It was actually put together by the NOVARISE team for all of us. And let's get started. So what's that number one fear or that number one belief or a lie that we keep in our minds every time it comes to an investment? And the first one is that age is an investing barrier. And that is not true. You have to forget the idea that there's a right age to start investing. Young or old is never too late or too early. It's about when you are financially ready. It's about your goals and it's about your willingness to take risk. Let's go over this example. Let's say you start putting away $12,000 annually at a 6% return from age 25. And you're considering a 2.5 inflation rate. And 10 years later, your friend follows your lead and starts investing twice as much. And by the time you're both 67, you could still have significantly more in your investment pot compared to your friend. That's $1,346,939 versus $948,698. I know it sounds like it's a whole lot of numbers, and that's why I want to do this nice illustration to help you better visualize what your future could be looking like. So let's say we have this timeline right here, right? And you are 25 years old right here, right? And you decided to invest today, right? $12,000. And then we have year 1, and then year 2, and then year 3, year 4, all the way to year 10. And then here when you and your friend hit 67 years old. Okay, so in this example, you're here, you're investing your $12,000 annually, right? So 12,000, and so on. And you're going to continue to do that all the way you hit 67. And then comes your friend. This friend decides to follow your lead because you're setting an example. And he or she is realizing that, hey, I need to put more money in order to catch up with you because I did not put money aside towards my investment for the first 10 years. So in order to make up for that, I'm going to put $25,000 every year. And you'll continue doing the same thing until you both hit 67 years old. So at 67 years old, your friend started late, but he or she took action, and your friend managed to accumulate for retirement a total of $948,698. You, on the other hand, because you started early, you had the luxury to put in a lower amount compared to your friend, and you had the advantage of time. And over time, you accumulated a whopping amount of $1,346,939. That's the beauty of compounding over the years. You start early and you get to accumulate more, and you don't have to worry about putting a higher amount towards your investment because you started early. That's not to say that it's wrong to start late. Remember that it is better late than never. So in both scenarios, it just simply shows a depiction that age is really not a limit. You can start either too early or you can start lay, both will lead you towards the same outcome, which is having money in your retirement. And having some money is better than having nothing at all. Now, moving on to the next slide, and that is you need to be a finance guru. There's a myth that you need a lot of experience or a finance degree to start investing. Is that true? Short answer is no. It's like when you're buying a car. When you go out and you buy a car, you do a lot of research, right? You want to make sure that whatever car you decide to put your money in, that you're getting the best bang for your buck, or that's the car that you like the most. So that's the same thing with investing. You do your research and you make an informed decision, okay? And when you do your research and you start applying those concepts, you gain experience by actually doing it. It's not the same as thinking, because thinking won't get you far, according to what we see in the article. But let's say that you're at that point in where you're so scared and you're not sure what to do, you can always invest in funds, for example. Funds are a relatively safer option because they are formed by managers who are already experienced investors, and the research and market analysis has already been done for you. So let's say, for example, you know nothing about investing, but back in 1980, you invested $1,000 into an S&P 500 index fund, right? And 40 years later, you will have about $70,000 in your account without following the market every day or being a financial expert. It just takes time. Just put money aside, take action today, okay? You don't need to be an expert in order to do that. Next lie that people keep believing in is that you need millions to begin. And that's not true, even though it's sad that many people think that they need to be ridiculously rich in order to start investing. And this myth probably comes from all those movies showing investors with a flashy lifestyle. But the reality is that you can start investing with as little as $15 to $35 a month. And here's a chart that illustrates this, but I actually want to break it down step by step so you can actually learn how to read this. So let's say, for example, you start with $500 and you invested at 5% annually. And you are going to add $35 every single month for 30 years. By the end of the 30 years, you're looking at $31,000. All right, so let's just stop right there and let's just move on to the tablet to better understand this illustration. So we're going to start with a clean slate. And once again, let's just work with this timeline right here. So today, right? And today you start investing $500, right? So that's what the example said. Then you have month 1, month 2, month 3, and so on, all the way until you hit 30 years, okay? So you put $500 right here. So let's say that this block right here represents your $500, right? Then next month you come in and you're adding $35 into the mix. So now your investments are going to look like this. So you have the same block representing 500, but now you're going to add to that your $35. You see what happened there? Your block actually grew. Then the following month, you're going to come in and you're going to put an additional $35. So what are we looking now? So we have the same block representing $500. Then you have the $35 that you add in the month before. And then you have an additional $35 from this month. And this process will continue going forward. And you're going to keep doing this and doing this all the way. And that's how the graph is going to go up. That's how your investment is going to grow. And in this case, this is how your investment gets to hit $31,000. So that's the same analogy that you're seeing in this chart. So bear with me. I know the colors can be a little blurry, especially if you're looking at it from your phone. But there is a blue line right here at the bottom. That blue line is your initial contribution of $500. And you can see it in here, and also you can see it in this chart right here. So the blue represents the $500 in the example. Then you're going to add $35 every month. And as you can see, that green represents that $35. And that 35 continues to increase, and it goes up and it goes up over time. And it will total $12,600. That's the total contribution of $35 that you make in the span of 30 years. And the yellow shows your interest rates that you earn. And this is where you see the power of compounding. The more money you put in, the more money the interests are going to compound themselves or earn based on the amount that you put in. The more money you put in, the higher the interest that you earn, because that percentage of the interest is going to be calculated based on the amount of money that you are putting in. So that over time is going to continue to grow. And as you can see here, that's how the table went up. And in fact, you can see here on the right that the total interest earned is actually exceeding the total amount that you contributed towards your investment. And this was just with $35. I know $31,000 might not be a lot, but remember, you started with only $35. And the analogy is that the more money you put in, the higher amount you're going to get towards the end of those 30 years. Now, let's continue with the next slide. But before I do that, I want to pause here and ask you to please subscribe to our channel only if you found value in this content. By you subscribing to our channel, you're letting us know that you're actually liking this type of content, which will indicate us that we should continue to create more content like this to keep providing value in your life and to keep helping you grow in your financial journey. Now, back to this article, lie number 4, you have to deal with debt first. Well, there's this notion, right, that you should be entirely debt-free before you start investing. Well, that's a nice thought. That's not always realistic. Let's just picture it this way. The average American, according to what you're seeing here in the article, is sitting about $59,580 in debt. Young adults under 30 owe around $24,142. And by the time people reach their 40s and 50s, it balloons to about $105,219. And that debt is coming from all sorts of places: mortgages, cars, education, you name it. And I'm sure you can relate to that. And here's the table to depict that. So if you were to wait to pay off every penny before you start investing, you could end up waiting a long time and missing out on some prime investing years. And instead, you should consider start investing now. Smart investing could potentially earn you returns that will help outpace your debt, meaning that if you start investing now, your investment can give you a return that's going to be higher than your debt, and you can eventually pay it off and still have money left at the end of everything. Remember, the best time to take action is now. Now, next lie. Gold protects against inflation. Is that so? Let's see. Gold's reputation as an inflation shield is well known, but it won't make you invincible. Yes, its reserves are limited and it can't be printed like money. As the dollar value decreases, gold's value in ounces often grows. It's true, the price of gold has generally risen over the last 50 years, shining brightest during economic crisis. That's why some view gold as a safe and conservative bet. Still, the price of gold isn't stable in the short run and depends a lot on the global political climate. And while long-term charts show a steady climb, as you can see here on the chart, short-term snapshots tell a different story. With this, I'm not saying you shouldn't invest in gold as an inflation hedge. What I'm trying to say here is that you should diversify your portfolio, because you can have gold sitting in your vault, whatever you want to place it. But what happens if there's an emergency and you need to liquidate that gold? And it so happens that in the moment that you need to liquidate that gold is not at its highest price. And by liquidating it, you can actually end up losing money, but you need the money at that time. That's why it's important to diversify. So when it comes to having to liquidate your investment portfolio, you get to choose which asset you want to liquidate. So that way you can pick the one that is going to give you the highest return for your money and not necessarily liquidate something at a loss. That's what I'm trying to say here. Next slide. Life insurance is an investment. Life insurance is important, yes. Still, it's not an investment tool, but rather a safety net. And here's why. Your monthly insurance payment, let's say $26, are for protection, not profit. This money helps your loved ones, if something happens to you, but it's not something you will benefit from financially while you're alive, at least not in the short term. Buying life insurance for the long term is another story, and that's not something we're going to cover today. Life insurance is a smart move for security, but when it comes to growing your wealth, sticking with actual investments like stock or funds might be a wiser choice. Another belief that could keep you poor: if you fail, you'll end up broke. I mean, let's put the drama on the side. I know that failure can be quite daunting It's very scary. And let's face it, it could damage your self-esteem at some point, right? But the beauty about this is that every time we fail, we learn something about it, right? And we shouldn't let that stop us from moving forward, or it shouldn't paralyze us. And this article reminds us that investment failures don't have to lead to empty wallets. Success in investing, it's all about preparation and strategy. That's why it's so important to invest in your education. That's why we create channels like this, so that way you can educate yourself and make informed decisions, educated decisions as to how you want to proceed with your investments. I mean, let's face it, every day comes with risk. From job security to car troubles, right? You can have an accident in your job. You can have an accident when you're driving. That's something we cannot prevent, right? But the beauty about this is that you're more likely to recover and learn from successful experiences if you educate yourself. So the real question isn't whether to invest or not. It's whether to take action now or let your fears hold you back and keep you poor. That's all for today. I'll see you in the next video. Bye-bye.